morning and welcome to Business Morning. I'm Chimeze Obi Iwag. Well, the National Bureau of Statistics just released the May Consumer Price Index, and it shows inflation increased to 12.40% year-on-year in May 2020. Now, this is 0.06% points higher than the rate recorded in April 2020, which was 12.34%. Increases were recorded in all divisions that yielded the headline index. On month-on-month basis, the headline index increased to 1.17% in May 2020. This is 0.15% rate higher than the rate recorded in April 2020, which was 1.02%. Now, the urban inflation rate increased to 13.03% year-on-year in May from 13.01% recorded in April, while the rural inflation rate increased to 11.83% in May from 11.73% in April. Our rural inflation rate in May 2020 is 11.26% compared to 11.20% recorded in April. The composite food index rose to 15.04% year-on-year in May compared to 15.03% in April. Well, this rise in the food index was caused by increases in prices of bread, cereals, potatoes, yam, and other tubers, oils and fats, fruits, fish, and meat. The average annual rate of change of the food index for the 12-month period ending May 2020 over the previous 12 months of average was 14.33%. That's 0.11% points from the average annual rate of change. All right, let's get a quick reaction there from the CEO of Financial Derivatives Company, Mr. Bismarck Ramani. Good morning, Mr. Ramani. Thank you for joining us. A quick one. Yes, your forecast was 12.47% up for the May inflation. Yeah, we have 12.40%. I guess it's still in tandem with what you had predicted. What majorly did your team see in the survey as the major driver?
Of error. And directionally, we were right in terms of we saw it going up at a much slower pace than it was earlier, and then much slower pace than was anticipated. Many analysts, both global and domestic, were of the view that inflation will run as high as 15%, including myself. But then we've seen a more modest and muted and benign shift in prices. Why is this happening? There are two reasons. One is that the pass-through foreign exchange effect, exchange rate depreciation, has not manifested itself. People are still carrying old stock on their books. Secondly, there's a crunch on demand to the extent that there's a lockdown and to the extent that many people are not at work. The earning power of Nigerians has actually reduced. Thirdly, we've seen a reduction in the price of petrol from 145 to 123 down to 121.5. This effect has been that transportation costs have actually gone down. Apart from the fact that there is no demand for transportation because there's interstate restrictions. But having said that, let us look at what it means. If you look at the core, that is inflation in May, month-on-month inflation in May 2020, you'll see that it is 1.17%, which means that when annualized, it is at 14.87. That is the more dangerous picture. In April, it was 1.02, which was annualized rate of 12.84. So the monthly inflation is a better reflection of what the current situation is than comparing what it was last year with what it was this year. Last year, at this time, there was no COVID. But this year, in April, there was COVID. In April, there was a lockdown. In May, there was a lockdown. So that's the situation. Chimeze, what we see is that the states with the highest rate of inflation are Rivers, Bauchi, Ebonyi, Kogi, and Plateau. All of them are 14.69, 14.91, and 13.87. Now, but the states with the lowest inflation are Kwara, Adamawa, and Benue. All of this in the middle belt, all of this in the bread basket. What does it tell you? It tells you that where the food is being planted, and because it's not moved from that part of the country to the urban markets, we are seeing a supply glut in the food basket, while we are seeing some shortages in the urban area. It also tells us that people are not earning money, so they have no demand. The spike in demand you have seen is because of people buying palliatives. Having said that, the slowdown in demand and slowdown in wages is going to have an effect. So we do not see inflation running away from us, except for the exchange rate pass-through, which is going to happen more in the next month or two.
All right, thank you very much, Mr. Ramani, for that quick reactions there. I'm sure we would have time to digest these numbers subsequently. And in the meantime, Mercer, an American human resource consulting firm and the world's largest outsourced asset manager, just released its 2020 cost of living survey. The survey shows that majority of African countries have risen in ranking in terms of expenses and cost of living for expatriates. This year, Victoria, that's in Seychelles, takes the lead as the most expensive city in Africa, while N'Djamena in Chad dropped 4 places from last year's ranking as the most expensive city. Tunis in Tunisia, again, ranks as the least expensive city in the region and globally. Now, in comparison with last year's report, Lagos rose 7 places due to high costs for rent and high prices for groceries, followed by Kinshasa, in the Democratic of Congo, which dropped 2 places. Accra, Ghana, moved from 63 to 57, while Nairobi in Kenya moved from 97 to 95, and Casablanca in Morocco moved from 128 to 121. Luanda and then Angola dropped significantly, moving from 26 in 2019 to 115 this year. Okay, joining me now to tell us more about this report and its relevance is the Associate Career Product at Mercer Africa, Didentel Kwape. Good afternoon, Didentel. Thank you for joining us.
Thank you for having me. Good afternoon to you too.
Well, this is morning. Good morning. All right. Yeah, this is the 26th edition of the Cost of Living Report by Mercer. Tell us about it. What is the aim?
Well, the aim of the survey is to for multinational organizations to use to determine the allowances that they give for their expatriates, employees in different locations that they send them to. And also it's a way of them to make sure that they maintain the standard of living for these expats that they are being placed abroad. It is a way for them to also make sure that they maintain their competitiveness in attracting and retaining talent.
Now, this edition is coming at a time when the world is grappling with COVID-19 pandemic. How will this survey help businesses, corporates, and even the government in decision-making?
Firstly, I'd like to say that we have 2 editions of the survey. In our first edition, which came right before COVID-19 actually hit Africa, that information will be able to see in our second edition. What it means for corporates and governments is this survey shows us, will be able to show you what are the important areas that we need to attend to, especially when it comes to expats. For multinationals, they need to make sure that expats maintain their standard of living from where they come from. They shouldn't change in any form or way. So it's very important for them to use this survey information. In terms of governments, it shows us in how attractive our cities or our countries are for these multinationals to come operate in them and send their skills to help us grow in our economy.
All right, this year's survey finds African countries rising in ranking in terms of a high cost of living. And then the report did mention Lagos rising 7 places when compared to last year's finding due to high cost for rent and high prices for groceries. What perhaps changed between last year and this year that gave rise to the high cost of rent and groceries in Lagos? Does it have anything to do with the COVID-19 pandemic?
At this current stance, no, we wouldn't say it has anything to do with the COVID-19 stance, because the survey was conducted early Feb to early March, which is before COVID-19 actually hit significantly into Africa. But in terms of why these rises exist, I mean, for a city like Lagos, in a country like Nigeria with a double-digit inflation rate, this will have an impact on the prices of these 2 aspects. And we also find in our survey that even practice in how accommodation, for example, standard lease terms, makes the accommodation expensive if, for example, a landlord would require you to pay a year, 2 years to 3 years worth of rent in advance. When in other countries you find that you ask for like a security deposit for a month. That's what makes it expensive in that stance.
Quick one before I let you go. What is your methodology in coming up with this data? Do you, by any chance, work with the National Bureau of Statistics? Do you track the inflation data?
We work with a number of researchers in doing this survey of ours. And we mainly look at the international basket of goods and services when we calculate into the rankings of the cost of living. We also, we've been doing this for a while, for over 30 years now. Our methodology is quite unique and quite robust. I mean, we look at over 200 items in each city that we cover. And this is across a number of categories when we look into the data.
All right, thank you very much, Didinto Kwape, the Associate Career Products at Mercer Africa. Thank you for your time. All right, let's talk oil and gas. The Department of Petroleum Resources unveiled a strategic plan and policy actions for the survival and success of participants in the nation's oil and gas industry post-COVID-19. Now, the strategies, which are hinged on 4 pillars, will center around the cost control, portfolio rationalization, strategic positioning, and partnerships. The strategic policies are expected to help Nigeria stay afloat despite troubles and threats posed by the coronavirus pandemic to the economy. I'm being joined now by energy lawyer and the chairman, Oil Trading and Logistics Africa, Mr. Emeka Akwabogo. Thank you very much for joining us, Mr. Akwabogo.
Thank you very much for having me.
So how do you see these planned strategies by the DPR, aligning with the vision of other regulatory agencies in the oil and gas sector like the NNPC?
Well, I think that it really is consistent with the new vision which the government seems to have post-COVID. I guess what has happened is that COVID has shown everybody that we've got to be a bit more prudent and disciplined in our operations. We've got to approach the governance of the industry from a point of view that sees, that is more detailed, more granular in its appreciation of the key elements that define and drive costs. So the DPR is simply more or less mirroring what the NNPC has said, as far as costs within the industry are concerned. And this is very important. If you make reference to a note which the GMD of NNPC made recently, where indicated that in the joint venture operations which the NNPC has with its partners, in some instances, the costs of production are up to $93 a barrel. And these are in cases where, and he says that while you have that happening, by the same token, that's for some companies, by the same token, other companies have as low as $9 per barrel. So you see that there is such a huge difference in the operating costs relative to different companies that obviously there is certainly something wrong. So costs are the key driver for, high costs are a key driver of inefficiency, and also the other way around.
Now, okay, yeah, the NNPC GMD has, of course, often talked about the fact that there is need to bring down the cost of production, and the target is that they have to get the cost of production down to about $10. But how achievable is that, and how can that be achieved?
I mean, I think the focus is on discipline. Of course, in how it can be achieved.
When you talk about discipline, what do you mean? Now, first of all, we have to understand what even drives these costs. Yeah.
So there is a segment which has to do with the operational patterns of the joint venture operators themselves. Then also there's an aspect which has to do with issues which government is in control of. So one of the key cost drivers in Nigeria in recent time, of course, has been security. So security is important, and government must take efforts, must make the efforts to ensure that the cost of security is reduced by ameliorating those events which cause insecurity in the first place. There are also community issues which are crucial, which must be dealt with. So government on its side must set the example by dealing with those aspects which are within its control. Then it must be disciplined in its relationship with the joint venture partners to ensure that the joint venture partners keep down the costs. So you've got costs issues arising from the range of the supply chain within the production value chain. So all operators within the industry have to also work within the nature of the environment which we have. You just finished a report where Lagos has been said to be the third most expensive city to live in Africa. Lagos is reflective of Nigeria, and we have a situation where we've got runaway costs attending most of our operations. So it's important that from a macro point of view, the government is a bit more prudent, but more importantly, in terms of governance and dealing with those granular issues that affect day-to-day living, then we also should be very, very mindful. The ports, for instance, if you go to the ports are congested. Apapa, you can't get a truck into Apapa or out of Apapa within 1 week. You can't. It's simply impossible. So under such circumstances, it's impossible for costs to be low. So what needs to happen is that across the levers of government and across the indices which make the industry tick, there must be greater efficiency.
Right. Okay, now let's come down to the downstream sector. The issue of petrol price control has become a major challenge. So just wondering why we are yet to see full deregulation in that sector.
Well, I'm sure that's a question that we'll put to the government, to the ministry and to PPPRA. But what has been said by the government is that they are mindful of the interest of consumers. They do not want the marketers of petroleum products to run away with prices which are outside the control of the consumers. That's a fair position, if you may put it that way. But of course, it's important that we have full deregulation. The reason is simple. Full deregulation unlocks value for government, unlocks value for the private sector. It unlocks value for the consumers because you see improved efficiency across the value chain. It indeed probably will lead to lower prices when you have competition which is running through.
Where does the PIB come in here?
PIB is important because the PIB needs to set out the framework, the legal framework, which ensures that you have full deregulation. Currently, you have a legal framework under which even if the government desired to, the government will be acting against the law if it doesn't follow price control measures which are in existing laws. The Petroleum Act has price control measures. The PPPRA Act has price control measures. There's also Price Control Act. So the point is, the PIB will reset the mandates of these organizations and remove issues relating to price caps. So the PIB is important along those lines.
All right, looking at these strategies as outlined by the DPR, do they also align to what is, or probably what should happen in the downstream sector?
Well, to an extent, yes. The DPR's outline has largely is largely towards the upstream as far as costs goes. But costs are also applicable to downstream. Of course, there are other parts of their measures which include portfolio resetting and strategic partnerships. Now, these are all very important. For partnerships, for instance, in the downstream, you need very important partnerships at this time. You need partnerships relating to benchmarking of pricing globally. You need partnerships relating to integrating operational models, because we have a situation where truly many individual marketing companies, in view of what has happened in recent time, really cannot cope as they are individually. So there probably will be the need for mergers within the markets and increased partnerships between government and the private sector on key elements. But at the end of the day, these things are important to the extent that they help the market to reset and help it to become more efficient in its operations.
All right, thank you very much, Mr. Akambog. Let's just hope we get it right eventually in the oil and gas sector.
Thank you very much.
Mr. Emeka Akambog is an energy lawyer and, of course, the chairman of Oil Trading and Logistics Africa. We'll take a break, and when we come back, of course, we talk gas. To stay with us. And with well over 187 trillion cubic feet of gas reserves, Nigeria ranks as the largest in natural gas reserves in Africa, with another additional 600 trillion cubic feet of unproven potential resources. Despite these potentials, only 25% of these reserves are currently productive, as not much has been accomplished in effective exploitation of these reserves. With the advent of COVID-19, the need to maximize our gas reserves has become imperative. I'm being joined now by the president of the Nigerian Gas Association, Mrs. Audrey Jo Ezigbo. Thank you very much, Mrs. Jo Ezigbo. Thank you for joining us on the show.
Thank you for having me.
So how do you see the world and indeed Nigeria reacting to the post-COVID-19 issues in the gas industry?
Right, thank you for that question. So interestingly, one of the things that has come out of the whole COVID experience is that countries have seen that there is an imperative for them to build their domestic gas markets. Now, a country like Nigeria, for instance, we have had twin shocks in the pandemic era, both from the pandemic itself, as well as what has happened with global oil prices, and we've taken quite a hit. Now, what it means for us is that it is time for us to look in country to see how we build consumption in country. So when you talk about being resource rich, it's really not so much about having the resource as to how much you can leverage it to create value addition in country. And I think this is one big learning for us as a country. Many others are looking at how they leverage on their own areas of core competence, competitive advantage, and create industrialization, create end products that can then be exported. And that's what Nigeria as a country must be doing at this point in time. So it's good time for us to rethink the way we have thought about gas, the things and steps we have taken to make gas utilization, monetization, commercialization in Nigeria a reality.
Is seen as a critical part of Nigeria's revenue strategy for the future. So what are the 5 crucial factors that, in your view, Nigeria should focus on for the purpose of maximizing gas?
Right, thank you very much. If I were to talk about 5, I mean, there's so many things, but I'll just pick on a few things. So first of all is in terms of policy and legislation. I think that there are too many policy gaps at this point in time, and there is a need for us to do a holistic review of the existing policies to find where these gaps are and how quickly we can bridge them. Now, a lot of our policy direction in the last few years has also been focused on incentivizing supply. And I think it's time that we look at policies that want to stimulate more aggressive utilization. So it's the demand drive we're looking at. And of course, we have to look at some of the policies that relate to things like foreign exchange, that relates to issues around pricing. Some of our policies are not as easy to implement in real terms. All right, so being able to operate and implement has been a challenge. And there are many of our policies within the gas industry that sort of signal they're not very friendly to private investors. And we have to look at that policy language that is largely punitive instead of enabling. So that's one key part. And of course, once we talk policy, we also then want to look at the issue of legislation. And that then brings us to the conversation about the PIB as an imperative to enable investments in gas infrastructure, in the gas industry. If I were to talk about a second thing, would be that of market liberalization. As the Nigerian Gas Association, we are very interested in seeing the evolution of a fully deregulated gas market where we have commercial transactions that are market-driven. So we feel that as a country, we have to allow for this self-sustaining, market-led, willing buyer, willing seller market to develop. And really, if you look back at the 2008 National Gas Master Plan, you will see that the intention was really to take us to this willing buyer, willing seller, liberalized market. But what we've seen in the past few years has been increasing regulation rather than liberalization. This has to change because we need for investors to come in. That's the second thing. If we're to look at a third, again, for us as NGA, we have been putting forward this position that government should look at gas as an enabling resource, rather than looking at what they can earn from gas at the beginning. They have to be thinking about gas as an enabler for much needed infrastructure, the growth of industry, the multiplier effects that come in terms of job creation, in terms of addressing unemployment, and then, the standard of living of people. Ultimately, they begin to earn the royalties, rents, and taxes that then feed back into the revenue basket. But we think that it's important to look at the kinds of fiscal incentives that bring investors back to the table, especially because when we discuss gas in Nigeria, we're usually talking about associated gas, which is the gas that we produce alongside oil. And like you rightly pointed out, we still have some reserves, 600 TCF of gas. We need to have deliberate exploration for our non-associated gas reserves, and that only happens when we have the right fiscal framework to incentivize investors. A fourth thing that is an imperative for enabling the gas sector is the resolution of the power sector conundrum, the liquidity issues, because as a country, we have over 80% of our power being thermal power, which means that then the gas sector is exposed in terms of our supply to that sector. And then what happens is that once there is a bottleneck in terms of the liquidity, there's a rollback effect onto gas supply, and it's an unsustainable framework that we need to deal with critically. As we deal with the gas to power value chain, we also inadvertently enable so many other sectors of the economy. So I think that's really key. And lastly, I would say, if we're talking about 5 critical things, is that we have to look as a country at what we're signaling to potential investors. Even before we had this pandemic, we had a situation where we were seeing foreign direct investments declining significantly in Nigeria, especially in the oil and gas sector. And we need to be able to pull back that capital. Most of the infrastructure projects we need to do, we cannot finance them as government. It's going to have to be private capital or in partnership with government. And with the pandemic, then it means that global capital is further impacted. So we have to look at the things that we have to signal to investors to show that Nigeria is doing her best to de-risk and make the gas industry landscape a bit more certain, a bit more commercially sustainable for any potential investor, whether it's from a policy point of view or in terms of legislation and the kinds of fiscal incentives, as I referred to earlier, that necessarily must be in place. These are things we have to be looking at this point in time to make our industry much more attractive once again.
Okay, now the gas master plan has been much talked about for upwards of a decade now. What, in your view, are the hindering factors for a full implementation, and what can be done to remove these hindrances?
Right. So thank you. Now, the gas master plan is really a very sore point in the sense that this was a concerted attempt to bring this holistic framework for development of gas in Nigeria, looking at issues around pricing. That was when the domestic gas supply obligations were put in place. And of course, that broad-based infrastructure blueprint that was supposed to do many things for us. It was supposed to address gas to power issues. It was supposed to stimulate gas-based industrialization, which is critical for Nigeria from many facets of the economy in terms of employment and so on and so forth. It was supposed to help to make gas available more broadly across the country and, of course, deal with our flaring issues. But somehow we were not able to progress that significantly. And here we are from 2018 to 2020, we're still having challenges with that. Now, what are some of the issues? Well, first and foremost is the fact that in terms of the domestic gas supply obligations, there have been issues around its implementation. And there are many reasons around that, which we can probably go into later. A lot of the infrastructure that was supposed to create the interconnects to enable the gas master plan has not been delivered till today. We keep seeing the dates shifting, and it's always due for completion third quarter this year, next year, and it keeps moving like that. We've not been able to resolve all the key issues around commercial frameworks for gas. Of course, like I said earlier, we have yet to pass the petroleum industry bill. And what this means is that we really don't have a very robust legislative framework when we talk of gas as a unique and distinct hydrocarbon in itself, as a fiscal resource in itself. We have not been able to develop our domestic gas market the way that we should. And so when you're talking about the gas master plan, issues about effective demand, how credible the offtake is, and so on and so forth come into play. We have a huge infrastructure deficit. So both in terms of transmission and distribution infrastructure, that's been a challenge. And then if you look over the past few years from 2018 till today, a bit of inconsistencies and uncertainties around the policy landscape. And as a country, whether we like it or not, we have to face this reality. We have focused too much on oil, and gas has only in more recent years begun to take its pride of place in the national discourse once again. So these are some of the things that have led to why we were not able to progress on the gas master plan. However, I think that when you talk about fundamentally issues around progress, we have to be able to acknowledge some markers of progress that were taken as discrete projects in themselves and fed into the infrastructure blueprint. So we have to acknowledge some work has been done in that regard. However, bringing it all together, it's important we once again as a country look back on policy, look back on the fiscal incentives, look back on the private sector partnerships that will help us to bring the infrastructure blueprints into reality. Okay.
So now, yeah, the domestic supply obligation, of course, is one of the most important policies of government that has an impact on gas. What are your views about the implementation of this policy so far, and in what ways can the private sector help government in its implementation?
Right, so that 2008 domestic gas supply and pricing policy again brought about the, in fact, this whole issue of domestic supply obligation came about because the government was looking for a way to incentivize gas supply into the domestic market, right? The idea was just looking for price neutrality because the focus was on export gas, which continues to be what we've been seeing for the last few years. And so, yes, the DSO framework has been a bit difficult to implement, but this is also because ours is a very, very difficult terrain to work in. There's been appreciable progress. We've seen significant flare down in the last 10 years, significant flare down. But in terms of the gas supply into the domestic market, there are challenges. I've talked about the infrastructure issues. Till today, we still haven't completed the OB3 pipeline. The AKK pipeline is another conversation. The ELPS-2 looping is still not complete. So we don't have this interconnectivity that would have enabled these domestic supply obligations. We have challenges with the off-takers themselves. Many times, the quality of the off-taker is a challenge to the gas supplier. And of course, the power sector is the bulk, the highest level consumer of gas. And so, like I said earlier, whether it's in terms of the liquidity issues, in terms of the transmission capacity, ineffective distribution, and of course, the cost issues, the cost reflective tariff, there have been many things that have constrained the DSO exercise. Of course, many times when they're reporting about the domestic supply obligation, the performance and the targets, you find that they're not making room for the constraints. There are some adjustments, factors beyond suppliers' control that are not taken into cognizance. So from our point of view, as NGA, looking at our members who are suppliers, we actually think they have done quite a lot of work to be able to support this policy. They've been able to expand some infrastructure capacity, fast track some of their projects, and so on and so forth, in the face of a very troubled landscape, especially on the gas to power side. Now, how do we get past this? So first of all is the question of how we've been doing it before. Why have we not seen the results we've seen, and what do we need to change? It's a matter of a higher level of handshake and partnership between the government, the industry, okay? We have to look at cost-reflective power tariffs. This is our reality. We can't continue to play the ostrich around there. There is an imperative to build more gas infrastructure because you want to see a broader geographic spread, taking gas to all parts of the country. We have to look at industry cost competitiveness. And I think I heard the last guest you had talking about the cost landscape in Nigeria is really very difficult. difficult. We have to look at the pricing mechanism. And again, this comes to the willing buyer, willing seller conversation, which I talked about earlier, and the issue of gas fiscals that can attract investments into the sector and grow the economy. We have to deal with the debt situation in the power sector and that whole power sector insolvency. And so on. I mean, there's so many things that we can put out there. What I want to say is that our members are willing and ready to have the conversations. They're open to the discussion, and they will do the things that they need to do to support in-country gas utilization. We already have members, people like Seplat, people like Frontier, like Axela, Falcon. There are many of us who are focused strictly on domesticating gas, and we're spending money to make sure that this happens. So all in all, it's really not about looking for punitive measures to implement the DSO. It's looking for a more conducive commercial, a more sustainable framework wherein the private investors are more willing to put out themselves to support this, this policy objective.
All right, thank you very much, Mrs. Joy Ezigbo. Let's just hope we get it right this time. Thank you for your time. Audrey Joy Ezigbo is the president of the Nigeria Gas Association. And for a review of Tuesday's trading activities at the equities market, we have Temple.
Yes, Chimeze, thank you so much. Of course, we've been seeing a lot of profits taken in the markets, the equity markets generally. Yesterday, we were down again by a margin of 0.09%. That's because toward the close of the market, there was a bit of profits taken on MTN shares in the market, and that then dipped this particular side of the market. The level of profits taken we saw in the markets yesterday now brought the year-to-date performance of MTN to a negative territory of more than 2%. Look at the equity capitalization. Given that sentiment in the market, we saw a situation where the equity cap then dipped to 13 trillion naira. Moving on to the activity level of the market, of course, we know that we had quite a bad market break yesterday. That's the market sentiment as it relates to investors' confidence in the market. 22 decliners in the market and just 13 gainers, and that was split between Naymet and FIDSIN. Of course, we know that Naymet has been recording some gains lately, but now we're beginning to see some profits taken on the shares of Naymet, and of course a bit of interest renewed on the counter of FIDSIN. So yesterday, FBN Holdings contributed more, 45 million units of its shares, or 27 million units of its shares was contributed to the volume of transactions yesterday, and of course the value was 140 million naira, which is one of what we actually priced into this 1.58 billion naira in terms of volume of transactions. Look at the sectoral performance. The banking stocks were down. Of course, this sector has been seeing a lot of correction in recent time. Major names in this part of the market was also down. We noticed that Zenith Bank was also down, and that puts the year-to-date negative or losses of that particular company to more than 3% at this point in terms. Consumer side of the market, we know the flour mills was down as well. Guinness also impacted that. But industrial goods side of the market, Boa Cement continues to push up this segment. Prestige Assurance, ICO Insurance, and of course, Mutual Benefits saw some profit taken yesterday. Oil and gas dipped by some 0.57%. But we have Mr. Abdurrashid Momo, trader with TRW Stockbrokers, joining us via phone now. Mr. Momo, thanks for joining us this morning. We have seen some sort of correction in prices at the market, but at what point we will begin to see renewed sentiment on these counters?
It can be any time from now. Definitely. From the last report I said the market was consolidating between its support and resistance levels. So as it is now, I'm not really normally, but for what I'm seeing, prices, yesterday's trades, we had more buyers in the market, but in terms of pricing, they went to buy stocks at a lower price. And the good thing that we are beginning to see strong volumes from the buy side. And for such buyers, they want to, since it's a buyer's market now, they want to buy stocks at a lower rate. But as I said before, the last time, I said definitely that market is still going to recover. We still have one more bull rally to go. This correction, as we are saying, is going to be, index will be at least, let's say about 24 to about 23,000 points before the next correction. And definitely we are still going to hit the 26,000 points plus to the uptrend. before the real correction starts. So for now, I'll still advise people to still take position as prices are coming down, because one more rally is still going to come.
Absolutely, because a lot of the fundamentally sound stocks at this point have found some sort of a resistant level. In some cases, it's even more of support level at this point in time. And I think Zenith Bank falls in that category. Mr. Abdulrasheed Momo, thank you so much for sharing your thoughts with us on the program this morning. Abdulrasheed Momo is a trader with TRW Stockbrokers, and of course, is a member of the Nigerian Stock Exchange. Chimeze.
Well, for investors, it's time to take position, I guess. Anyway, Temple, hang in there. We'll be back with you for the debt and currency market after the break. Welcome back. We start off this segment in London with Juliana Olayinka. Good morning, Juliana. What do the market streets look like this morning in the face of the downbeat assessments of the economic impact of COVID-19?
Good morning, Chimeze. Well, actually, the FTSE opened up 25 points higher this morning, and this is despite what's going on with China. Of course, there is Sino-Indian wars going on, and we have that new information that Beijing has cancelled about 40% of flights coming in and out of the capital because of a flare-up in infections. So it did open up higher, and that's also in spite of this new inflation data. We've seen that inflation in the UK has fallen by 0.3% between the months of April and May. In May, it's now at a record low of 0.5%. I don't believe it's been that low since after the Brexit referendum vote in 2016. Now, a lot of economists are putting this to the fall in fuel prices. And if you flip that, it's potentially a good thing, because we know that a lot of customers are up and down in the high street spending their money. So if prices are much lower, then perhaps people can spend more, because, of course, they're not really earning at the moment. But we're expecting now tomorrow the Bank of England Monetary Policy Committee to do more asset buying. We're expecting that to be increased by about £100 billion. No word yet, or at least no sign yet, that interest rates will go into negative territory. Of course, at the moment, they're at a record low of 0.1%. And the Bank of England governor has signalled that he doesn't want to follow suit that we've seen by other central bank governors. Worth also mentioning very quickly that Boohoo.com have really surprised shareholders and the retail market. They've posted quarterly results of 45%, which is pretty shocking, considering a lot of nobody's been going out over the past 3 months. Boohoo.com, they're a fast fashion brand, really popular with kind of C-list reality TV celebrities. They're massive in endorsing them, and their shares rose by 9%. They're not actually on the FTSE 100. They're on the alternative listed market, but that is a huge story in the business world, because at least it seems that there are some online retailers that are bucking the trend.
And in another development, the head of the city watchdog, the FCA, has told banks to prepare for a surge in business customers falling behind on their debts. But, of course, they warned firms must be treated fairly to avoid a replay of 2008 when trust in lenders collapsed. How exactly does FCA want the banks to go about this? They, too, have to survive, don't they?
Well, I think history tells us, Chimeze, that banks don't have a problem with surviving. They've got enough money in their coffers. But this is a really interesting story, particularly as, Boris Johnson, the Prime Minister, and the Chancellor have really kind of been held for the success in their furlough scheme and helping businesses stay afloat while they have been in lockdown. And so far, about 860,000 businesses have taken out money, and 3 of the big coronavirus support loans, and that's cost the government and banks about £38 billion. And now, yesterday, the head of the FCA was speaking to some senior bankers, and he was warning them that they should prepare for many of these loans to go bad, particularly the bounce back scheme. Now, the bounce back scheme was the last loan that Chancellor Rishi Sunak announced, and that was really because there was pressure from so many small businesses who were saying that banks just weren't playing ball small, and they had to go through so much red tape to get their hands on some money. So they were receiving up to £50,000 cash within 4 days of applying. And now what the senior man was saying yesterday is that 50% of these loans will be bad, and they want the bank to prepare for how they will be trying to get this money back from customers. We do know that it is 100% backed by the government, but before the government rush in, the banks do have to try and claw back this money. And again, yes, he did mention 2008, and he does want banks to be prepared, particularly as they were not prepared at the start of the coronavirus scheme. There was so much bureaucracy taking place. I think there have been a lot of criticisms facing the bank, particularly during 2008, where a lot of business owners were saying that the banks were pushing them into administration so they could make money from liquidation. So it's an interesting story, and I think this should be, of course, a worry to the government, because, of course, they're loaning money to people, but the FCA, the financial watchdog, is saying most people just won't be able to pay the money back.
All right, let's talk a little bit about sports. How much do you know about Newcastle United Saudi Arabian-led takeover deal? Now, the proposed £300 million deal could be complicated by the World Trade Organization ruling that Saudi Arabia helped breach international piracy laws.
Well, I don't know enough about football, I must say, Chimeze. One thing I do know is that the Premier League is back in action tonight, so I'm sure football fans will be happy. But it's an interesting story. The World Trade Organization have been looking into allegations that the Saudi Arabia government have not been strong enough in tackling sport piracy. This was a case that was put forward by Qatar, who accused the Saudi government of allowing a streaming box to play illegal sporting matches to fans. So they weren't paying for them. It wasn't regulated. And the World Trade Organization ruled that the Saudi kingdom did not have enough criminal procedures in place to prevent these people from showing these matches. There was a 104-page report, and during the report, it doesn't actually mention the takeover between Newcastle, but there have been some back and forth movements between this £380 million takeover, because Newcastle fans are desperate for it. Over the years, a lot of these big Premier League clubs have seen billionaire takeovers, and it's really transformed the productivity of the team. Newcastle have been pretty stagnant for decades. Mike Ashley is the owner. Mike Ashley is a pretty popular, well-known businessman here in the UK, and the fans don't think he has done enough to help propel the team. So they're desperate for this takeover, and there are concerns that this is going to put a spanner in the works, particularly as soon as the World Trade Organization came out with the ruling. FIFA acknowledged it and supported it and said that they don't think Saudi has done enough. So perhaps they are going to be swayed. But the deal isn't dead yet. It's still a 50-50 chance, and Newcastle fans will be hoping by next season they will have a rich Saudi owner so they can get some expensive strikers.
Well, we'll keep hoping for the best, and we'll look forward to getting more updates from you later in the day. Thank you, Juliana. And back here, Temple is still on standby to give us the debt and currency markets. Temple, I'm sure you're also a fan of football.
Not really. Actually, don't get that wrong. Well, anyways, before we talk about the debt and currency side of the market, look at what the NASDO-OTC showed. It moved back up from 600 psychological position to 704.98 yesterday, thanks to the positive movements that we saw in volumes around CSCS, which gained more yesterday. And of course, NDEP, Niger Delta Exploration Production Company, which contributed some 54,000 to the number of volume yesterday. Look at the debt and currency side of the market. Bonds yesterday was not so much of improvement, but then eventually we saw a bit of buy interest, which reduced the yields by some 8 basis points to 9.9% on the average. And of course, for the NTB, not so much of performance. Things remained around the 3.39%. The yields yesterday was actually flat. For the OMO side of the market, quite a number of buy sentiments on this angle yesterday. In fact, we saw a situation where the yields dipped increased to some 4 basis points, by some 4 basis points rather, to some 4.89%. But we have Akpeve Oputu joining us now via phone, and she is actually a trader, a fixed income dealer with Access Bank. Thank you so much, Ms. Oputu, for joining us on the program. Let's look at the auction of 164 billion naira to be raised by the DMO today. What direction are we likely to see the stop rates facing eventually?
Okay, thank you for having me. Good morning. There's actually 150 billion on offer at the bond auction holding today, and we expect to see bullish sentiment play out at the market like we have seen in the secondary market. So we expect to see an oversubscription at the auction, and we expect to see rates decline slightly at the auction because we see the secondary market yield trading much lower than we saw the stock rates at the last auction, where we had the 2023 bond come out at 9.2, the 2035 stock rate came out at 11.7, and the 2050 came out at 12.5%. So we're actually looking to see a reduction in the rates this time around and the swap rate.
Okay, thank you so much, Akpeve Oputu, a fixed income dealer with Access Bank PLC, a member of the Nigerian, or a listed company on the Nigerian Stock Exchange. Thanks for sharing your insights with us on the program, and let's hope that will bring about some liquidity on the secondary side of the markets tomorrow after the auction today. It's back to you now, Chimeze.
Thank you very much, Temple. We hope for the best. And it's on that note that we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi. You're welcome.